If you bought bonds to protect yourself during this sell-off, I need to show you something. Because right now bonds are falling alongside stocks at the same time, together. This is not supposed to happen. And the fact that it is happening is the most important macro signal of the week. It changes everything about how you should be thinking about this market. I'm going to show you exactly what's going on, why it matters, and more importantly, where the money is actually going instead. So let's get into it. Just a quick picture of where we are right now. The S&P 500 just hit a fresh low a couple of days ago. We are now at 6,672. NASDAQ also hit a fresh low a couple of days ago, and we are now at 24,520. The Dow doesn't look much better, and we are now at 46,666. So every major US index hit its worst closing level of the year this week. That's not a correction anymore. That's a sustained distribution. Institutions are not buying these dips. And normally, in a sell-off like this, you'd expect one thing to be going up: government bonds, long duration treasuries like TLT, the classic fight to safety trade. Stocks down, bonds up. That's been the playbook for 15 years. Except right now, TLT is also bearish. Yields are rising, and that tells you something very specific about what the market is actually pricing. It's not pricing a recession, it's pricing stagflation. Let me explain why that word matters. Stagflation is when you have inflation going up and growth slowing down at the same time. It's the scenario central banks hate most because the tools that fix one problem make the other one worse. Want to fight inflation? Raise rates. But raising rates crushes growth. Want to support the economy? Cut rates. But cutting rates makes inflation worse. The Fed is caught, and right now they have every reason to be. Look at what's driving this. The Straits of Hormuz, the waterway that routes roughly 20% of the world's oil supply, is effectively closed following the Iran conflict. Maritime traffic through the strait is down over 90%. Oil jumped from around $70 to nearly $95 a barrel in 3 weeks. So that goes straight into inflation. Gas prices, shipping costs, manufacturing costs, everything gets more expensive. At the same time, CPI is already sitting at 2.4%, core at 2.5%. Consumer confidence is near decades low. Goldman has raised recession odds to 25% this year. So the Fed meets in 5 days. They can't cut, they can't hike, they're going to sit there and watch. And the bond market has figured this out, which is why bonds are selling off. Investors don't want to hold long duration debt in an inflationary environment. They rather hold something that actually holds its value. Which brings me to gold. Gold is right now at 5,093. And before you ask, yes, that's a real number. And yes, the move is real. Using the institutional volume terminal, gold is showing a VWAP of 8.4%. For context, that's the most extended reading of any assets in the framework right now. Institutions are sitting more than 8% above their cost basis on gold on this 4-hour chart. And here's the thing about gold in a stagflation environment. The usual rule don't apply. In a normal market, an asset that extended above VWAP would invite mean reversion. You'd expect a pullback. But in stagflation, gold doesn't mean revert. It reprices because every new buyer coming in, whether it's a central bank, a pension fund, or a retail investor, finally waking up. They are buying at the new normal. 5,000 was the line everyone was watching, and it held. And it's now the floor. So gold is not a trade right now, it's a regime signal. Here's a quick one that not too many people are talking about. Silver is also supposed to be a safe haven, and silver is actually down today. Why? Because silver has two jobs. It's a safe haven, but it's also an industrial metal. Solar panel, EVs, electronics. Silver needs global industry demand to perform. When growth slows, that demand gets priced out. So while gold is capturing pure inflation and geopolitical fear, silver's growth component is being discontinued. The gold-silver ratio expanding like this, gold outperforming silver significantly, is one of the cleanest stagflation signals you can read in the metal markets. It's been happening since late February, and most people haven't even noticed it. Now, here's where it gets interesting. Bitcoin is now at 71,000 and almost 700. So while the S&P is hitting new lows, while the NASDAQ is hitting new lows, BTC is not falling, equities lower. On the IVT framework, Bitcoin's volume compression reading, the measure of how tightly the price is coiling before a directional break, it just hit 97% and building. That is near maximum compression. The only thing higher in the framework right now is ARK, which has a compression of 100%. So think of this like a spring. The more you compress it, the harder it releases when it goes. And 98%, that spring is almost fully loaded. What I find more interesting is the context. Usually when equities are selling off hard, crypto follows. High beta, risk off, crypto gets hit. But right now, BTC is sitting above its institutional VWAP baseline and building compression and not breaking down. And that tells you there's institutional accumulation happening under the surface. Smart money is quietly positioning while the equity sell-off grabs all the headlines. So I'm not calling a breakout. The compression can resolve either way. But when it breaks, the magnitude will match the compression. And at 98%, you should be paying attention. So what do we actually watch from here? We have three things. First, the Fed on March 18th, the language matters more than the decision. If the signal even hint a stagflation acknowledgement, expect another leg down in bonds and another leg up in gold. So you have to watch the TLT. A recovery above 88 would be the first sign that bonds are finding a bid again. Second, BTC's confidence score. Right now, it's only at 2 out of 9. I want to see it reload above 4. That's the signal that the compression is breaking bullishly and not just compressing further. So without that reload, it's a watch, not a trade. Third, equity stability reading. Right now, SPX and NASDAQ both show zero stability. The first sign that distribution is ending will be a stability reading ticking from 0 to 1. And that's not a buy signal. It's the first warning that conditions are starting to change. Until then, regime right now is speculative. Composite is -4 out of 9. And equities are not safe. So follow the flow. And real quick before you go, if you want to see this full framework and the complete V13 score table, the radar, the AVAP levels, and on every instrument, all of this is in the members area at cantillonresearch.com. Today's brief is free for everyone, so the link is in the description. And if this kind of analysis is helpful to you, please like and subscribe to this channel. It really helps me a lot. New videos will be dropping every week, usually around market events like we are seeing right now. So have a great day and trade safe. Bye bye.